Much better now. So today, guys, we're going to discuss about shorting. Straight up discussion, and the caveat is we are going to discuss it using Pepsi cans, which is, yeah, I know I have a problem, but whatever. Hey guys, so first of all, for the record, no, I don't have a drinking problem. I can actually stop whenever I want, so don't worry about it. So, shorting a stock is a tool where we can make money when a company's stock loses in value. And I'll try to explain it using, of course, Pepsi cans. While it's considered quite easy to do, I find it very risky, and we'll discuss that a bit later. But let's say myself, I want to short Pepsi stock, for example, because I think in the future, they're going to announce that they didn't make that much profit this year because, I don't know, I've been going shopping every single day and Pepsi cans haven't been selling that well. So let's say for the argument, they're going to go down in price. So let's say currently in the market, we have all these Pepsi cans, and a Pepsi can would represent a share. And one Pepsi can one share is going to cost $2. And we think at the end of this month, it's going to cost only $1. So this is the way that shorting works. So I'm going to pick up the phone or go online and speak to my broker and say, hey, Mr. Broker, I want to short one share of Pepsi. And the broker says, fine, okay, these are what the broker owns. He has in his portfolio 5 Pepsi shares, and he says, okay, here it is. He's going to take this Pepsi share, and he's going to sell it into the market. So it's now in the market. So for $2. Okay, so now we have our $2 in our hand. So hopefully we're just hoping in a month the price is gonna fall. So let's say I was right, and 1 month later the price is now $1 per share. So what happens is I'm gonna call my broker and say, hey, I want to close out my position. So what really happens is I'm gonna take this dollar, pay it to the market. The market is going to give me back my share, and I say, thank you, broker, for your help. Here's your share back. So at the ending, I made profit. I had invested when I had shorted when the price was $2, and then I went out of the short when the price came down to $1. So actual difference was my profit. And that's pretty much it in the concept of shorting. Now, the problem that I have with shorting, which is why I find it super, super risky, is when, let's say you invest in the market, right? So again, this is the market, I have $2, and let's say I want to buy a stock for $2. So I buy it, I put my money into the stock market, paid somebody else, so I have this share, which is costing me $2. Let's say the company goes bankrupt. What's the most I lost? Well, this becomes useless with no value, and I lost $2. Okay, I can live with that. But the problem is when you short a stock, we make profit on the end of the share losing its value. So thinking about that, you can only make money as much as the share drops. So imagine this, if this was $2 and if the share goes down to zero, and we're shorting it, the most money we can make is actually the full money we put in, $2, which is a limit on your profit. But there's no limit on your losses, because let's say we did the actual shorting on this, and we shorted it when it was $2, and we were hoping it's going to go down to $1. What actually happens, let's say it goes to $1,000, $1 million, because there's no limit on how much a share could shoot up in price, and that could definitely bankrupt us. And that's where the actual risk lies. Always be careful when shorting a stock, because your margin for winning is limited by the share going to zero. But there's no risk covering you guys if the share goes as high as possible, especially when you dealing with penny stocks. Again, be careful, guys. Thank you so much, guys, for your time. Hope you guys stay safe, take care, and drop me a comment down below. How many cans do you think I actually own? Take care, guys.